Hello, my name is Nicole Elliott and I'm a technical analyst and private investor. And today I thought I'd look at all things Chinese, in that at the moment everybody is blaming everything on the trade spat between the US and China. We've also got the IMF now blaming this, as well as Brexit and all the rest of it, chucking at in the sink, who are meeting this week in Washington, D.C., World Bank, IMF joint meeting, where, can you believe it, we're going to have 10,000 delegates attending. I mean, talk about climate change. Anyway, the first chart I've brought for you is the exchange rate between the Chinese yuan and the US dollar. This is a sort of managed currency, shall we say, and it has been weakening over the last year and a half. So that's sort of one of the tools of the trade spat. I mean, you know, you can weaponize the currency. We all know that. And this is nothing new. It has been going for some time. The record strength of the yuan was 6 to the US dollar, and it did start trading at 9. So we've just reached 7.15 this month, which is halfway between the two. And this is quite a good place where you want to be. Neither too hot nor too cold, and plenty of room to go in either direction. And I think they're going to need that because things in China are tough. Auto sales, for example, are down in the last 15 of the last 16 months. New apartment viewings, I read in the South China Morning Post. I didn't know this, but new apartment viewings tend to get clustered into the week's holiday for the Chinese National Day, which we had recently. And according to them, viewings in Beijing and Shanghai have absolutely collapsed this year. Now to my second chart. And again, this is something else that you can use in a trade spat, is your interest rates. And we know that the Fed is looking at this, and Mr. Trump is very keen for the Fed to cut rates. Well, the Chinese are doing this, and they've got several tools in their armory. One is the reserve requirements. This is the yield on a 10-year benchmark sovereign bond denominated in yuan. And you can see that for months and months now, the trend is to lower interest rates. Now, this is an interesting one because the first bonds were issued only in the year 2000, and it's very much something that they want to internationalise. So they've got to do this very, very carefully. But I think we're going to go down to the record low, which is 2.5%. My final chart today is of the steel rebar futures contract traded in Shanghai. That's rebar stands for reinforced concrete, and is absolutely essential in construction industry, as is cement, as is steel, as is copper, as are all sorts of things. It's a weekly chart, and you can see that for months and months it's been trading round the blue line, which is the mean regression of that period, and well within 2 standard deviations nearly all of the time. But what we do have is a slight sort of gentle, shallow, rounded top formation. We're now trading below the Ichimoku cloud, which is acting as resistance, and we're beavering down towards that lower standard deviation and the 50% retracement support level. As and when we break through those, I would suggest that the top is complete and we have quite a bit lower to go, which ties in with a slowing construction market in China. I mean, they're not alone here because property speculation as an investment vehicle, I think, is coming under scrutiny, and perhaps it will become less in favour than it has been. I will be back with you in a fortnight's time, and I thought I'd look at all things Japanese because they too are having a trade spat with South Korea, and things are getting tricky for everybody in Asia. Thank you for watching.